Hi, everyone. Welcome to our webinar today entitled Kicking the Tires in Private Equity Healthcare Services Deals in 22. I am Ari Markenson. I'm a partner at Venable in their healthcare and corporate groups in the New York office. I've got three wonderful folks joining me today to have this conversation. In a second, I'm going to ask each of them to introduce themselves so that we're not spending time with me reading crazy bios. And then we'll get into our conversation. With that said, Pete, why don't we start with you and just introduce yourself quickly? That'd be great.
Sure. Thanks, Ari. Thanks for having me here today and appreciate everybody joining. I am Pete Tedesco, a managing partner with Health Enterprise Partners. We are a lower middle market private equity firm based in New York City, focused on investments in healthcare services and healthcare technology businesses. A core piece of our investment strategy is the fact that we count, in addition to financial investors, 19 hospital systems and 17 health plans as limited partners in our funds. And we try to leverage those relationships to direct our outbound thesis-driven sourcing and find companies that are solving pain points for the healthcare industry. We leverage those relationships to help us, vet and diligence our companies, and then, ideally, in the best case scenario, we are accelerating the growth of the businesses in which we invest by leveraging those strategic industry relationships. Personally, I've been investing in healthcare private equity since 2007. After starting my career as a banker, I joined Wad Capital Partners in 2007, and previously worked at Olympus Partners prior to joining HEP in 2015. Thanks again, Ari.
Great, thanks, Pete. Nick, why don't we go to you?
Great. Thanks, Ari. Really appreciate the opportunity to join here. Nick Coleman, I'm a vice president with Exelir Partners. We are a Denver-based private equity firm, primarily focused on partnering with founder and entrepreneurially owned businesses where we're the first institutional capital, and really helping those groups achieve their vision for growth and scale those organizations, as well as build the foundations to help them support that growth throughout their hold period. We're based here in Denver, and I've joined the organization in 2013. Worked on a number of our healthcare partnerships and currently work within our PPM service line, working on developing our origination strategy around new opportunities and areas where we feel like there are opportunities to invest in. Thanks again.
Great, thanks, Nick. And Mike.
Hey, everyone. Mike Volpin. I'm a managing director at Vestar Capital Partners and co-lead our healthcare vertical. I've been investing in the healthcare private equity space for about 15 years now. At Vestar, we're a middle market private equity fund based in New York City. We invest in healthcare, business services and technology, as well as consumer. And within healthcare, we spend a lot of time around the intersection of technology and healthcare, software, data and analytics, tech-enabled services, in addition to broader outsourced services and other pockets of healthcare services. Pleasure to be here today. Thanks, Ari, for the opportunity, and look forward to the discussion.
Great. Thanks, gentlemen. I appreciate it. Thanks, Mike. So we just couldn't even start out this conversation without acknowledging that we are on what we all hope to be the back end of 2+ years of an interesting, the pandemic, for lack of a better term, right? And we're hopefully getting past those issues, right? All the issues that have affected the marketplace and investing in healthcare services businesses, particularly as a result of the pandemic. Competition for deals has come back dramatically. Valuations have gotten crazy and don't seem to be calming down. So we're in just another frenzied marketplace again for healthcare services transactions in the middle market in healthcare. With that kind of as a quick 30,000-foot level set, right, of what's going on. Let's focus in on what we're going to focus on today, which is kind of how are we kicking the tires, right? How are we looking at these transactions with that backdrop? And I'm going to start out with asking Pete to take the lead on a conversation about sort of, have you changed your diligence processes at all, given what's going on? Is there a different timing about when you're going to dig into looking at a deal or not? Pete, why don't you get us started with that, and then we'll open it up to everybody else.
Sure. Yeah, happy to kind of spin through some quick thoughts there. I mean, look, yeah, it is as competitive as ever. Maybe I'll put to the side some things that we're starting to see now, which is particularly on the healthcare IT side, but some of the value-based care and healthcare services platforms, the ones that have recently gone public, SPACed, et cetera. There's some softness in the valuation of some of those public companies that we're certainly monitoring and seeing whether it will, kind of start flowing down into the private markets a little bit. But look, it continues to be a very competitive market. Healthcare is a place that has attracted a ton of investment dollars, and there's a lot of private equity capital out there to be investing in our markets. And so, given competition for both timing and we've certainly changed, our processes, and frankly, it starts with the very beginning. We're highly selective about where we play. We tend to identify somewhere between 8 to 10 investment themes, and they're broad, right? When you think about things like chronic care management or behavioral health, right? Very large, broad themes, but we're doing work to understand those markets and the players and everything. And therefore, when we see something that, we know we have a lot of conviction in, we run really hard and start digging in and doing the diligence work and our market checks and everything, as soon as we get that introduction or have the first conversation with the management team. On the flip side, if it's something that, seems interesting, but it's kind of opportunistic, it's not necessarily in a market where we already have experience or have done work and therefore have a lot of conviction, we candidly just shut it off and don't do the work, because the idea that we're going to get up to speed on something and compete on value and timing with folks that already know that space or have had a success investing in that space, it's just not going to happen. You're wasting your time, you're wasting your resources. So we're running really, really hard after opportunities where we do have that conviction, and just pulling back from things where we don't. And what that running hard means is, we're trying to do everything we can to shortcut our diligence processes without taking shortcuts, I guess. Poor term, but tighten up the timeline of our diligence processes without taking shortcuts. And so, many things that could look like, which we can kind of get into, but we tried to use time and kind of conviction and experience in a space as a way to combat the fact that we may not be the absolute top value, top dollar valuation, and still be competitive.
Great. Thanks, Pete. Hey, Nick, anything to add to that?
No, I echo a lot of the same commentary and a lot of the same themes. I think if you're coming into a situation without an angle or an understanding of the market, you're already a few steps behind other folks who are spending time up front, doing the research, understanding the key trends, and what's driving the business from a macro perspective. So spending that time up front and making sure that you're spending the team's time on areas that you or the firm have a good understanding of is really what's driving where we are looking to focus our resources. And one thing that we've been trying to do and really have implemented, less formally historically, but more formally, recently over the past 6 to 9 months is, coming to the IC committee with 3 to 5 key threshold items right away. What is going to potentially impact our decision on a go, no-go situation or on valuation, and then identify exactly how we're going to tackle those 3 to 5 things and get comfort with them. Come back to the IC summary and then feel really comfortable about the offer that we're going to be putting in, as well as how we're going to get to a closed transaction quickly. The other items that we're trying to do and continue to do is bring in executives or industry experts that we work with who really know the space well and bring them in early. We think that it helps us on our side drive and understand the industry even more so than we already do, and also helps us continue to build credibility with the management teams and help get that buy-in, because it's going to be competitive. Folks are going to be there from a valuation standpoint, and in order to win in a competitive process, you're going to have to come with a little bit more than just value in our perspective.
Mike, anything to add to that?
Not a lot. I mean, I agree with everything that's been said. We take very similar approaches. We pick our spots within healthcare. We're a relatively small but nimble team, and so we take a thematic view. We identify a few areas that we've got a lot of conviction around the growth and the tailwinds, and then spend time actually mapping out some of these spaces, studying the landscape, getting to know companies, and to both Pete and Nick's points, trying to develop a point of view and conviction before a process actually starts. And echo a lot of what Nick just said too, in terms of leveraging our prior relationships, some of our operating executive resources, our current and prior portfolio companies. I think, anything that we can draw upon to help give us that kind of edge or angle or information advantage, or help us get over the hump on a conviction level to pay the market clearing price, are all things we do similarly to how Nick and Pete described.
Thanks. And Nick, I'm going to turn it back to you, and it actually kind of builds on something you were just talking about anyway, which is just a quick question about, are you having any difficulty getting the advisors that you want to look at a deal? You're running into any more conflicts than usual? And the reason that I'm asking that question, I know you all recognize this, is because the competition in the marketplace right now is really kooky, and you can obviously run into, if you've got more people than usual running at a deal, more people than usual are trying to lock up their advisors, and it can become an issue. So.
Yeah, no, I think that's a great observation. And while we've been lucky that we haven't run into conflict per se, I think it's more than fair to say that all third-party advisors were incredibly busy, and particularly, I would say, heading into the back half of 2022. In order to try and address some of that, and frankly, some of the whisperings we were hearing about potential lead times for some third-party advisors, we were reaching out, in some cases a month plus ahead of time to try and get in queue of when we actually thought that we would need them to be engaged on a full-time basis to get a report done on the timeline that we needed. And so we were able to get in that line or in queue in order to get it done. But it was definitely a shift in the market, and you really had to be thinking forward to, if we're really excited about this opportunity, if we're really going to run hard at it, well, we need to be making calls today about something that's going to need to start a month or a month and a half from now. In particular, I would say on portfolio companies where there was a lot of add-on activity, we actually did in some instances reach out to our very close relationships and try and lock in a dedicated group of folks to help us process those if there were 2 or 3 opportunities that were coming down the pipeline. But there's definitely a flurry of activity and something that we had to plan for as we were thinking about our diligence process.
Mike, any thoughts on that?
Yeah, look, I think the last summer through the end of last year was incredibly busy across the whole industry. And I even know of some examples or things that we have been a part of that where actually processes got pushed out because there just wasn't enough diligence capacity in the market to be able to serve that. And so I think that was probably most acutely felt on the commercial diligence and market diligence folks, Q of E, vendors, legal advisors as well. But I think similar to what Nick said, I think we try to be creative and trying to give existing relationships, folks we do a lot of work with, an early heads up on something maybe sooner than we otherwise would. And then in some cases, actually expanding our relationships and working with new folks, using that as an opportunity to sort of grow our network a little bit. But I think my sense is, Q1 of this year, things have normalized a little bit out. So I'm seeing less of that, but I think it was an interesting time in the market. A lot of activity, a lot of deal flow, people still needing to do work on tight timeframes, given the competitive nature we talked about. Just finding enough resources to actually do the work was the challenge. But, I think hopefully that was a moment in time, and going forward, it'll always be busy and competitive, but, not to the same degree it was last year.
Pete, anything to add to that point?
I'll just say, yeah, it underscored the importance of relationships, right? We tend to have a handful of providers across kind of all the diligence areas, with maybe kind of one backup in each counsel, Q of E, et cetera, commercial diligence, et cetera. For us, it was less, we tend not to be participating in broader processes, given we're truly kind of lower middle market, a lot of founder run and owned businesses. So it was less about conflicts and more about, to the point that both Mike and Nick made. If I'm going to put in my LOI and look someone in the eye and tell them that we're going to close on X date, and nothing was more intense than 12/31 right last year, I need to know that the diligence providers I'm using have the capacity to do that, to hit that timeline. Otherwise, I look really bad. So, we were, to the points Mike and Nick made, lining up folks, as we were going through the diligence process, certainly before we were submitting an LOI, to say, if we say we can close in 45 days, do you have bandwidth as an organization to take us on and help us get there? And if not, that's fine, but I need to know now, because I can't have it get to 40 days and you say, gee, we're just not, we're not getting there. So I think it's some advanced planning around that, particularly in a situation where you're trying to use timing as a lever or a differentiator has been kind of the important part.
Great, thank you. Mike, let's circle back to you to start talking about a question about sort of, are your creditor partners, right? Your financial backers, your lenders, your commercial lenders, your direct lenders, wherever you're using, do you feel like they're looking at over your shoulder, looking at the deals that they want to do with you differently?
Yeah, it's a good question. I think what I've seen, there's a lot of parallels with what's been happening in the credit markets as in our private equity market, in terms of just record levels of capital flowing in, funds getting bigger, people expanding strategies. So I think there's still a lot of money that needs to be put to work into transactions from the credit side. I haven't seen folks be less aggressive, if anything, probably more aggressive on the lending side, but for the time in 2020 when everything kind of shut down for several months. I think the lenders' willingness to be aggressive as people kind of came out of COVID, various degrees of, portfolio taking different lumps. I think some that may have been more exposed to travel or lodging or retail may have taken a different risk aperture, last year. But I think the good news for healthcare is our industry snapped back very quickly, and has held up very well on a relative basis. So, based on our relationships, conversations we've been having, just keeping a pulse on that market, it feels like on the other side of COVID, actually, people want to put more money to work into healthcare from a credit standpoint. I think they realize some of the resiliency to it. And in some cases, particular with HCIT and technology companies, lenders are doing things now that they hadn't previously done, like lending off of a revenue ARR type multiple. I think the number of lenders that are doing that these days used to be able to count on one hand, and now it feels like everyone's starting to move in that direction, just as a data point of the market continuing to get more aggressive. So I haven't really seen folks pull back, at least the folks that we work with and speak to. As with us, I think some of the challenge over the last year or so has been figuring out what the normalized earnings are of some of these businesses that were impacted by COVID, sometimes very positively, sometimes negatively. So I think that's obviously a focus in trying to underwrite these transactions over the last 12 or 18 months, but still a lot of conviction, a lot of people willing to do aggressive and sometimes unnatural things in the credit markets.
Nick, thoughts on that?
Yeah, I would agree. I think the lenders are feeling a similar atmosphere or similar pressures as folks that are on the private equity side, direct private equity side. They're trying to be competitive. They're trying to put money to work, and whether that means through terms or that means through speed or that means through kind of diligence processes, they're also trying to be creative and be a value-added partner to us. And I think for us, again, a lot of it comes down to the relationship that you've built with that group. We have a number of folks that we've been working with for a long time, and that we have really strong business as well as personal relationships with. And I think having those honest conversations up front around what you're looking for from a leverage profile, what kind of diligence is going to be done, what kind of reports are going to be provided, the timing of that, and making sure that they're on board with kind of your plan to mitigate a lot of the risks that are out there can often alleviate any potential conflict later on in the process. I think the last thing any lender wants is a surprise that the diligence wasn't provided in a way that they were expecting it, and the last thing that we want is a surprise from them that they're not going to be able to get there. And so having that open communication is important, I think, particularly in this market where a lot of folks are vying to put capital to work, as Mike had mentioned, and in some cases extending themselves into situations that maybe they wouldn't otherwise.
Pete, thoughts on that?
Yeah, one kind of additional thought would just be, as we all move a little bit more quickly, the only thing I think Mike's spot on that, there's still just so much interest in putting capital here. And so we haven't really seen the cracks, in sort of the market generally. I would say from a diligence perspective, the one thing we kind of found was just sort of hey, you might be moving quickly, but you're still doing all the same stuff, right? Just kind of wanting to confirm that even though, a timeline might be, might be accelerated, that we're not, back to my prior account, we're not taking shortcuts and just, we're not going to do background checks. We're not going to do compliance diligence, because we just don't have time for that. So, just I think a general kind of confirmation that like, hey, we're all still good here, right? But beyond that, we haven't seen, a whole lot of, kind of increased scrutiny, from the lender community.
Thanks. Before we jump to the next one, just a couple of quick thoughts, which hopefully I'll give you guys a chuckle, which is in relation to what Pete just said. Just a couple of days ago, I had a conversation with a client looking at doing a deal, and one of their advisors who was going to do some billing and coding diligence was saying to the client that if they really were going to look at the universe of claims for this particular provider that they really should look at, they're going to need some time. They're going to need a few weeks. And the client said, well, can't you just look at 4 or 5 just to give us a snapshot? This was a provider that dropped 40,000 claims a day. And I just jumped into the conversation and I said, "No, that 4 or 5 charts really isn't going to work here." Like, I understand the timeline. I get that we want to get this done, but that's just burning money for, I don't even, not even that much money, but you're not, it's a completely useless exercise, right? And that the diligence has to make sense, right? The other thing that I'll say, just hopefully gives everybody another chuckle, which is that I get about 3 or 4 calls a day where literally the only comment is, "I have no idea how she's doing that," or "I have no idea how he's doing that." And it's essentially some other lender or some other PE fund who lost a deal to somebody else and just saying, like, "I don't get the numbers. Like, I don't get how that worked for them, because if I could have gotten there, I would have gotten there, and I just didn't." And just shows you that what's going on in the marketplace, that there's a lot of folks interested in figuring things out. And I don't know that people are necessarily smarter than the next guy. It's just that that folks are using their money in different ways, or figuring out how much they feel comfortable with risk in a certain deal, and being able to move into it. Pete, did you? I thought you were shaking.
Yeah, I mean, I think that last piece, right? It's everyone underwrites in a different way, and I don't know how somebody else is pricing their capital, but I also don't know, what angle somebody else has that I don't, right? I thought I did, I think I have a pretty good angle, and and I like it, up to X, but you know what? They feel really fantastic about it, and and like it up to Y, because they know that they can do, some things afterwards. So it is super frustrating when you get in those, in those moments. You try to just step back and say, hey, listen, somebody else, saw something that we didn't. Or you tell yourself they're idiots, and how could they ever pay that much? And it's going to, completely burn to the ground. And thank goodness we missed that one. So.
Yeah, that's a good way to be able to sleep at night, at least, is to tell yourself
right,
that.
Exactly. That's how. I did how many months of work just to lose out by that much? That was a horrible thing.
Call me when you need a good workout lawyer kind of thing. Anyhow, let's move on. So I think we're on to P, to a question about kind of has the RWI marketplace changed in terms of what you can get, what you can't get, given all the different dynamics that are out there?
So, right, using a historical context, sure, it has evolved to the point where, healthcare is now, kind of universally accepted in RWI, whereas, when it was first, coming out, their healthcare deals, let alone healthcare reps, were, it was like that. That's just not, we weren't equipped to kind of underwrite that from the RWI provider side. What I would say, kind of happened last year, at least we saw towards the end of the year, some of the deals that we do as a new platform are going to be too small for RWI to make sense, economically anyway. But even on exits, where it's pretty standard, or some of our new deals that are a little larger, we did see some of the underwriters saying, "Hey, look, we can't do anything more for the rest of the year. We've written our entire book of business, let alone our healthcare specific book of business." So we had, buyers for one of our companies that was transacting at the end of the year, a business we were selling, come and say, "Hey, listen, we went to every carrier, and we're not sure we can get the coverage. So we're gonna have to go back to old fashioned, reps and warranties and indemnities and stuff like that." And it's like, well, how bad do we want to sell, this year versus, do we push off till, push close till January 2nd? And could we then get, would that open things back up, and, kind of try to trade off, certainty and speed relative to, reps, indemnities, holdbacks, escrows, et cetera. I think fact of the matter is rep and warranties are here to, rep and warranty insurance is here to stay, and, and only going to be increasing. All those firms to try to staff up as much as they possibly can. And so, long term, I think that was kind of a short term, resource and kind of allocation issue that we saw towards the end of last year. I think it's going to continue to be a big piece of of transactions as we move forward here.
Mike, any thoughts on that?
I agree with a lot of what Pete said. I mean, I think RWI has sort of become a permanent fixture in transactions these days. The market's matured a lot. It's evolved around healthcare transactions. And, I think also over the last year or two, there's actually been some claims that have come out of it. And, I think that was part of the initial concern, is that a lot of these new carriers were underwriting this product that everyone was signing up for, and remained to be seen when stuff hit the fan, whether these folks were going to stand there and actually pay out claims. And I think that's largely worked. Fortunately, I haven't had to go through that process, but I've heard others, and I think the product's working as intended. But as Pete said, late last year, Q4, there was a lot of these places just shut down and said, we've written our book for the year. We're not willing to underwrite new policies. And, we weren't faced with this situation, but I know others that were, that, some sellers basically just signed up to a regular way indemnity deal because they wanted to get something closed before the end of last year. So I think that's normalized itself out this year, but it's another good reminder that, market activity has its limits, and we all want to be aggressive and put money to work, but there's sometimes a ceiling to just how much the market overall can absorb, just given all the inputs that go into these transactions.
Nick, any thoughts?
Yeah, I don't have much else to add. I think we saw a similar dynamic at the end of Q4 last year. We did see a handful, or maybe not a handful, a couple of new entrants into the market who were writing additional risk on that side. But I agree that I think this is something that's here to stay, as Pete and Mike said, and it's just a permanent part of kind of the deal environment at this point.
It's interesting, and Pete, you and I may have had this conversation not too long ago, and if we didn't, ignore what I'm about to say. But one of the RDO carriers that I know had told me recently that they're not leaving the marketplace. I mean, they like what they do and they're very good at it, and but they've gotten incredibly selective. They even have gotten to the point where if they really don't feel comfortable with the diligence that's put in front of them, rather than price it, they'll just say to their potential client, look, it's not, I don't want to ruin a relationship. I'm not even going to give you a number, right? It's not worth it. It's not worth having the conversation. It's just not something we're going to want to touch, and it's very interesting, because I think if you rolled back 3, 4, even 5 years, the carriers were happy to quote you an insane number and just say, look, you want to buy it? Here's the number, Yeah. And I found it very interesting that this is a very sophisticated carrier who basically said, look, I've gotten to a point where, I'll tell the counsel involved, I'll tell the clients that the folks want to buy the policy, look, I don't even want to price it. It's you're not showing me something that makes it make sense for me to price it, right? And they said that they've gotten, more, as far as they're concerned, more quality out of the policies that they're writing, and although writing less policies.
Sure. I mean, look, it's the same thing that we just talked about that we were doing as equity firms. It's like, for them, that's going to take, even if they price it right, if it's not, not business they like, they only have so many slots, right? Just like we only have so many portfolio companies, we have so many deal teams we can run after things. And so from their perspective, why am I going to, price and do business with something that I'm not thrilled about, and but more importantly, take an allocation and a deal team and, and all that away from one that, I'm kind of iffy on, or I feel like I need to price higher, versus the one that I'm super, super excited about. And, I can price it aggressively and think I have a good shot at winning. And I'm going to be really excited to kind of win. So I think ironically, it's a similar, it's sort of when your resources are constrained, it forces, kind of that focus, and, they may be tighter priced than they would like on a better book of business, but, it's a smaller but better book, like you're saying. And, it was never going to be, they couldn't do everything that came after them anyway. When they had a ton of capacity, both in terms of underwriting capability as well as people, okay, sure, I'll price it super high, and if you want it, great. But the constraints that we've all been under in the last sort of year, let's call it, I think have forced some of that focus.
Yeah. So Nick, let's move on and talk a little bit about kind of, look, we've talked about all different kinds of things going in the marketplace, but if you put those things aside and said, I don't really care what's flying around the marketplace, there's no way I'm doing a deal without doing 1, 2, 3, 4, and 5 in terms of diligence. What are those must-haves?
Yeah, so we talked a little bit earlier about some of those items that are more so on the go no-go decision, the valuation side, understanding kind of the tailwinds, how you're going to attack that, understanding how you're going to add value, and those really set the table for being aggressive in your bid, or being aggressive in your conversations with the founders or owners to take that next step. I think once you move beyond that and you're working through some of the more detailed, nuanced diligence, for us, it really depends on the type of business or the end market that you're looking at. Within healthcare, organizations can deliver a lot of different types of services and products, whether it's healthcare IT, whether it's a PPM business, whether it's a highly regulated manufacturer of drugs or otherwise, and trying to pinpoint those items. But in particular, when it comes down to really the quality of the organization, for us, quality, regulatory compliance, coding is something that we just won't kind of back off on. Those are extremely important to us, and the organizations we're trying to invest in those that provide better quality, are in a position to create better patient outcomes for the folks that we do touch on the patient side, and really move the healthcare system forward. So making sure that we're partnering with an organization that has that solid basis and it really has a quality focus is extremely important to us as we're heading into a partnership. The other item I would say, particularly on the reimbursed healthcare services side, is a pretty fulsome buy-side Q of E, and I would say more so focused on the Q of R side. Revenue recognition is something that is fairly nuanced in our view, and can have a pretty material impact on your profitability, as well as the valuation you paid and what your capital structure looks like if you have a miss. And so we're pretty big sticklers on that side, as far as making sure that we feel comfortable with the quality of revenue and quality of earnings. And the other item that really does come to mind is if it's more of a products or B2B type business, is just having those conversations and discussions with the key customers to get a better understanding of how they view the business, the value that they're seeing from the organization, and getting comfortable that is a long-term relationship that's really valued by the folks that the organization is servicing.
Mike, thoughts on that?
Yeah, I would just say, a lot of the, in addition to just doing the work and a lot of the table stakes elements to diligence, I think we spent a lot of time, focusing on, what are the 1 or 2 key things that would cause us to have a different view on growth, assuming everyone's smart and up to speed on a business and the market's efficient, and everyone's going to do a similar amount of market work. I think trying to find the spots where we can bring a differentiated angle or perspective or level of conviction around something that would allow us to underwrite a higher level of growth, and build conviction. So I think we prioritize things like that. And then on the similarly on the downside, I think we also focus on what are the 2 or 3 things that if you get wrong could completely blow up the whole deal, and really spend time pressure testing the downside. And as Nick said, I think those things are sector and business model specific, whether it could be a reimbursement or a regulatory thing or a kind of a technology thing. But I think we try and keep that in mind of, what are the 1 or 2 things that are going to allow us to lean in and underwrite a different level of growth than others may otherwise. And then what are the couple of things that, if you got wrong, you could really lose your shirt on the investment. So, addition to what Nick said, I think we try and also kind of prioritize the both ends of the spectrum in terms of, what you need to believe to drive a successful winning of the deal and ultimately have the low level of conviction to clear the market, but also acutely focused on the downside.
Pete?
No, well said by both Nick and Mike. As first institutional capital, most of the time in our deals, it's compliance, it's background checks. But I think Nick's point was a great one, on rev rec and revenue cycle, in healthcare and healthcare services is a place that, if you're not doing it right, your EBITDA is not anywhere near what your cash flow is, and you're toast. So, I think recognizing healthcare is not, consumer products, so that's maybe not a great example either. With how regulated healthcare investments are, to Mike's point, you really need to protect that downside, and there's extreme blowout risk if these things go poorly. So I think there's always that focus towards, okay, what are the things that we need to understand that would totally blow this up, and not only end up in a poor investment, but reputational risk for the company, for us as investors, et cetera, certainly us as board members. So it's no matter how fast we get the the diligence processes, there are certain aspects like that of covering your downside that just they're never going to be shortcut.
So next kind of point that I want us to think about and talk about is there's been for a while now, but certainly more as the competition in the marketplace increases, a lot of preemptive diligence being done, right? Used to be somebody would just do like a billing and coding audit and throw it in the data room, or maybe even a Q of E on their end or something, and now it's gone even further sometimes, depending on the transaction and depending on if there's a banker involved and so forth. And Mike, why don't you talk a little bit about how you view that kind of stuff? Is it useful to you? Do you discount it? How do you look at it?
Yeah, it's a good question. I think I agree. You're seeing more and more of it. I don't. I think it's the exception where I think we find kind of the sell-side work a substitute for things we would normally do ourselves. I think we always do our own work and work with our advisors, but I think it helps streamline the process. If a company has already taken the step to go through some type of diligence work on their side, more often than not, that means they've already sort of thought through the most logical 8 to 9 questions that folks like us are going to ask. They've organized the data in a way that makes it efficient for us and our advisors to do the work. So I think it overall is helpful to the process. I don't think we take any of that at face value. I think it's a starting point. We obviously work with it, and our advisors leverage that, and always looking for ways to not have to recreate the wheel. If it's a quality of earnings, I think not having to start from scratch, starting from a sell side point of view and figuring out how we would think about it differently is always a more effective and efficient process. So I think we're seeing more of that. I think it's in some areas it's interesting to see how folks do this. I think a market study is pretty typical. A Q of E is often typical, but been seeing some other situations where people, like you mentioned, Ari, a billing and coding audit or technology diligence, or things that maybe have a bit more nuance to it. On the outside looking in, sometimes companies and advisors serve things like that up, and it sometimes raises more questions than answers on why you addressing something like this up front. But overall, I think sellers, companies, and advisors are trying to find ways to make these diligence processes more streamlined, and making the investment up front to do some of that work on the sell side, I think helps overall.
Pete, thoughts on that?
No, well said by Mike. I think the biggest piece is one of the things Mike was hitting on for us. It's if they've been through the sell side work, then at least because it's probably sub 50% of the new platforms that we're doing have already done some of that, right? So I don't have to explain to them what the quality of earnings is, what we want to see, like I need your QuickBooks, and the same thing through compliance code and market reports, et cetera. So just the fact that at a minimum they prepared at some point the information to get their sell side advisor up to speed and putting something together means I know I can go a little bit more quickly. I'm not taking the sell side advisor's work, like Mike said, as a substitution for our own. But at least I know they've thought through some of these questions and they've been through a process. So ideally a lot of the information is off the shelf, but if not, they at least understand the questions we're going to be asking and why. So and I think it gives you confidence that at least somebody's been through and checked this, and it's not completely asinine, and there's huge swings that are that we're going to find and just like walk away type hey, your earnings are just nowhere near what they were, or coding is just a complete disaster. So never going to be a perfect substitute, but at least it means they've been through the process and understand what we're looking at.
Nick, thoughts from you?
Yeah, I think Pete and Mike covered it perfectly. I think if you didn't take that with a discount, and no offense to the sell side work, but we really wouldn't be doing our jobs, frankly. And I think what it does do, to both of their points, is it does provide some confidence, at least in your bid, that you're not going to have to come back after you do, particularly on the Q of E side, and hopefully reduce price by 50% because they haven't done any work and they have no idea what their earnings are whatsoever. And it does also provide you, as both of them mentioned, a more expedited path because a lot of that information is already available. And also, a lot of times our advisors can reach out directly to their advisors versus, in a lot of these, founder-owned businesses, there's really only one point of contact who maybe doesn't know how to use QuickBooks at all, right? So you can go to that group's already done a lot of that legwork and spent the weeks pulling that data to help navigate kind of your diligence stream.
Yeah, that's interesting. I would say that this is not by far, it's not a usual occurrence. But it's been interesting that I've seen, particularly more so recently, once in a while, sellers come and say, we done a billing and coding audit, we looked at some regulatory issues, and we've actually uncovered some issues. Oh, but by the way, you can fix them post-closing, and we still want 18 times for our business. And the buyer kind of scratches, or potential buyer kind of scratches their head and saying, what did you just say? Wait a minute. Particularly, by the way, with a lot of the PCMSO type structures and professional services businesses, where they've gotten corporate practice issues and other kinds of things completely wrong and structured the business in the wrong way, and the seller just coming to the table and saying, "Oh, you can fix that all at closing," and even their counsel saying, "Yeah, we notice it's a problem, but we'll fix it all." And look, it's a business decision at the end of the day in terms of the cost of fixing it, right? But to some extent, depending on the issue, it can say something about the seller's business as a whole, right? And you don't, it may be hard to put a box around what that means, right? It's one thing for an auditor to have found, a 10% error rate on their billing and coding, and then say to you, you got, that's sort of normal for us, you'll fix it. But, when you look at the sample size they use, going back to my joke of an example before, but, you're saying to yourself, well, wait a minute, like, what's, peel back that onion, what's really there? I don't really know how to handicap that. It's a bigger problem than the seller's kind of making it out to be, or at least it could be, right?
Yeah, one of the pieces you just said, or reminded me of I guess another benefit, at least to the sell side work, which is that at least you should all be largely bidding off the same information, if that makes any sense. Whereas, there's a, and I won't get into specifics, but one we looked at recently where there was a pretty decent regulatory overhang with this, sort of applied to multiple companies, but this company, had it, and it was both a potential compliance risk historically, as well as a growth overhang going forward. And so when we went to bid and even an indication of interest, we had done enough work. We had a prior investment in the space, so we had done enough work to know about that. And we were told by their advisor that we were like 50% off, where everybody else was bidding. Well, there was no sell side work or anything done on this. I don't think they spoke to, a sophisticated healthcare, regulatory counsel like yourselves. And as a result, a lot of other folks that maybe didn't have the same knowledge that we did about the space and about that regulatory overhang weren't seeing it, and we're totally discounting it. And so, or we're not discounting it like we were. And so, you kind of say, all right, well, geez, am I being penalized for kind of doing more work at this phase? Should I go and play the game of, hey, we're going to pretend the value's here, but we all know it's going to come down, just so that I'm in the game, as opposed to sort of saying, hey, I think you guys are wrong. Call me when the bids come down, 50%. Do you get that call back? Probably not. So all that is to say, having done the sell side work at least allows for no huge gotchas, that there's just like a situation like that, the value of this company is drastically different.
Yeah, and I just love being the guy who pointed that out in the first place, right? Let's move on. Hopefully, we can capture two quick other things we wanted to talk about. If not, we'll do our best to finish up. Let's talk, and I think, Pete, it was going to come back to you, just about what, if anything, you're doing differently to address the sort of just insane multiples, and trying to really figure out, whether what folks are asking makes sense, and if you can actually do a deal that way.
Yeah, a couple things. I mean, candidly, Mike said it earlier. It really just comes down to how do we have an angle for growth that can justify where we are coming in at from a value perspective. I mean, that's the name of the game. And is the company kind of already on that trajectory, or are there things that we can or need to do, to be able to accelerate it? I mean, end of the day, that's really, kind of the bread and butter, right? You can run the analysis, sort of addressable market and stuff like that. Most healthcare markets are big enough. You're probably not going to bump up against, sort of TAM issues. Two other pieces we've been looking at, and though I'll tell you, we've been doing it for the last, 5, 6, 7 years, is, underwriting exit valuations, multiples, often at a decline to where we enter, despite the fact that we expect to, triple or quadruple EBITDA over our whole period. So, just not assuming that entry value is exit value, as, sort of your most basic models typically kind of start. And the last thing we tried to do, though it's tougher and tougher to get these days, is put in some structure in our security and the way we're investing that protects our downside. So that, yes, I'm in at a very high valuation. There's still a lot of upside, but at least I'm able to, kind of protect, myself against losing my shirt. Dividends, preferred, sort of preferred, features and other bells and whistles to try to, allow for us to get at least kind of a floor on our return, relative to what is a, kind of a nosebleed entry valuation.
Nick?
Yeah, I think ultimately to win out and to be comfortable with winning out, I mean, ultimately, I think the saying is if you won an auction, you probably maybe paid too much because you paid them more than anybody else. So you really got to think that you are able to do something that others can't with that opportunity. Whether that is because of previous experience, because of your relationships, because of maybe an executive who wants to join and help drive the business. To really Pete and Mike's point, it's what's your angle and what makes this a different opportunity than just opportunity B that's sitting right next to it and is also going to go for a high multiple, but you're not willing to go there. And when you're looking at those underwriting cases, to Pete's previous point is, what do I think what are the bigger risks and what is the potential downside here? There are businesses that have a lot of upside, but also have a lot of downside as well. And so how do you find the right balance between the price you're paying, what that ultimately means for your return, but on the flip side, how comfortable are you with the long-term success of the business, regardless if that's at a 3 or 4 or a 2.5, and what is the potential downside to the extent it goes the opposite way. But I think ultimately it comes down to the intangibles of why is this something you're willing to stretch on, and what can you do with the organization that maybe some others who are looking at it don't think they can or aren't able to.
Mike, any thoughts?
I think it's been well said. I think to the point on the downside, I think for a period of time, I think some folks would say, oh, valuations are crazy levels. Who would have thought paying 14 times for a vet business? As just a random example, but in hindsight, those are really smart bets, and now people are saying the same thing, but fill in the blank, high teens multiple. So, I think you can't just sit on the sidelines. I think you need to pick your spots and figure out where you've got conviction, to Nick's point, on paying that market clearing price. But I think the range of outcomes is important. There are certain types of companies and opportunities where, despite paying a high entry price, there is real right tail potential to earn a outsized return. But I think in the context of the downside matters more, when you're kind of coming in at a much higher entry valuation. So I think we've been, we're, for the most part, majority control investors and traditional, buyout shop. I think we've over time have opportunistically thought about growth investments for some of the reasons Pete mentioned, where if you could get some structure to the investment, some downside protection via security, sometimes that may be a more interesting way to play an opportunity, just given where the valuation is. So I think we think about some of those things selectively, but ultimately it comes down to what is the range of outcomes you're willing to underwrite, and to what degree your level of conviction on kind of the downside relative to the return opportunity.
Great. Well, thanks. I want to try and wrap up with something that's been kind of really affecting the healthcare PE space. Well, I don't know if I can say affecting, but it's been an interesting issue that's been flying around, and that is kind of the ton of rhetoric in particularly coming out of DC, that how private equity is essentially bad for the business of healthcare, right? And it's I will admittedly say that some of it I think is totally bizarre. I suspect that all of you would agree with me that you wouldn't touch an investment in the skilled nursing world in a million years. But the margins in the skilled nursing world are pretty darn low, and they really don't make for good investments. But there's been an enormous amount of scrutiny of private equity investment in the skilled nursing world in Congress, and I'm not really sure why. It's been very interesting. Anyhow. In general, have you, given that you're seeing, articles in the New York Times and the Journal and so many other places, and hearing so much about how Senator Grassley wants to hold hearings on private equity investment in healthcare and so forth and so on, and MedPAC wrote a report to Congress about private equity investment in healthcare. Are you doing anything differently about how you are looking at the companies you're getting interested in and eventually, bidding on and buying, from a diligence perspective, right? Are you doing anything differently, given any kind of concern about where the wind is blowing? Pete, let's start with you.
Yeah, look, I think it gets back to some of the points we talked about around, managing your kind of your downside in healthcare investing, right? You have big compliance, sort of blow ups, et cetera, are the types of things that, will put us in the headlines as as an industry. I would come out and say I vociferously, feel that private equity is good for the business of, the business and the care of healthcare. But, we're really only investing behind, technologies and services that are going to, improve care quality, lower costs, or, improve access and patient experience. It sounds pretty easy to say, but if you kind of keep those in the back of your mind as sort of, when I'm thinking about making an investment, if fundamentally what I'm doing and what my business is doing is addressing, some or all three of those pieces, then you're going to be on kind of the right side of investing in healthcare. That said, can you do it in the wrong way? Have there been kind of bad actors and I shouldn't even say bad actors, bad situations, right? The situations where companies get over leveraged, and end up blowing up, that way. Or I think if you think about where Congress is focused, it seems like it's predominantly SNFs and brick and mortar hospitals, which I think are a small portion of where private equity plays. I think and there's certainly starting to be organizations that are bringing to light some of the positive impacts of private equity on again, access, outcomes, cost. But I think just getting back to kind of keeping your eye toward, okay, from a diligence perspective, here are the areas where this thing could totally blow up as both an investment and and a company and their impact and in their community. As well as, again, how am I making sure that this isn't just a game, a business is a game to justify building a code that doesn't actually do anything for kind of improving our healthcare landscape.
Nick?
I think Pete did a great job of summing it up. I think ultimately you've got to have conviction in that the businesses that you're partnering with and the ones that you want to work with are enhancing the healthcare system across those multiple points that he mentioned, whether it's access or quality or cost, patient outcomes, that you're improving the experience and the environment for all the stakeholders, whether that's payers or providers or patients or facilities. And that's how you can really try and make sure that you're driving things towards a better place. I think you look at particularly on the provider side, there's a lot of folks who don't have the resources or otherwise make the investments, to make that transition, whether it be to value or it be to enhance technology, to increase patient care coordination or access or otherwise. And when you look at a lot of these platforms across the different end markets, there's a lot of good that I do think is being done by making those investments, having folks who are thinking, what should this look like 5-10 years down the road, and supporting those folks in trying to get there. You know, a lot of founders and entrepreneurs may be hesitant to make those investments coming out of their pocket right away or today, whereas I think the private equity landscape is a little bit more forward thinking and making that investment today so it pays dividends going forward, not just in the form of profit, but in the form of outcomes and a better healthcare system more broadly speaking. So that's kind of how we think about it, and taking a look at the businesses that we're looking at to make sure that they're adding the value to those stakeholders is kind of how we think about it. You definitely obviously need to be aware of the rhetoric and what's going on in the environment, but I don't think if you're worried about that, generally speaking, then you may also be potentially looking in the wrong areas of where you're trying to find opportunities in the industry.
Mike?
Yeah, I agree with what's been said. I think, you know, we also keep that in the back of our mind of, you know, companies and founders that we look to partner with, bringing at the end of the day solutions or technologies or services or care delivery that lowers costs for the overall system, provides greater access, better quality. You know, those are all the kind of triple aim of healthcare, so to speak. And I think, you know, there's a lot of companies and founders focused on that, which is great. You know, investing in healthcare, though, does come with some degree of headline risk, and it's hard to completely avoid that. But I think it raises the bar on, you know, to the points that have been made on you know, making sure from a compliance and risk standpoint for those subsectors where it applies, that you're doing your work and your homework and thoroughly assessing, you know, the quality of these organizations, and, you know, whether there's any kind of significant gaps that can't be mitigated quickly. I think there's certainly some examples of folks that have gotten involved in situations that, you know, may be great companies, great organizations, but for one reason or the other, it doesn't take a lot for, you know, one bad example to turn into a headline, and then you get painted with a broad brush. So I think it's certainly in the back of our minds as well. And I think overall, the regulatory intersection with healthcare is some, you know, folks that have been around this industry for a while and focus on it, you sort of learn to navigate it. But I think it also provides opportunities on the same token. You know, some of the rules and regulations that have come out of Congress over the last couple of decades have created industries in some instances like the EMR space, or created, you know, noise around drug pricing and things like that. I think there's going to be a lot of new business models and new growth opportunities that arise from some of the noise today in Congress. And you know, I think it's a double-edged sword, but certainly something that we spend a lot of time thinking about.
Yeah, it's interesting, and I'll circle back to where Pete started, and first of all, say admittedly, the four of us are a bit biased in terms of responding to this question, right? But even with that said, if you looked at case studies of two pieces of the industry, right, professional practice management and case management, okay, disease management, okay. In the 1990s, when both of those industries, so to speak, took off, or subsectors of the industry took off, the way they were doing things, first of all, there wasn't a lot of significant private equity backing of those pieces of the industry back then. But the way that they did things was very human capital intense. You know, particularly in disease management, you had a nurse call a diabetic and say, "Did you take your medicine today? Did you do this? Did you tell me what your blood pressure is?" Right? Push that forward 15, 20 years. You get into a point where you've got private equity backing of businesses that are very technologically advanced and technologically heavy in terms of how they're handling practice management or disease management. And it changes the dynamic dramatically. And by the way, the capital to put that technology in right was not going to come from a small physician practice, right, or within that practice, or was not going to come by somebody who had this great idea to start having, you know, blood pressure monitors that were connected to somebody's cell phone that could just automatically transmit the information, right? And that dramatically changed those subsectors of the industry. Interestingly, right, most professional practice management companies now are quicker to spend money on the iPad that deals with revenue generation from the get-go, right, from the minute they see the patient, than to paint the walls in the waiting room, right? Back in the 90s, the practice management companies were so focused on, can we put nice sofas in, and can we paint the walls, and can we make this practice look like, you know, concierge and so forth and so on, yet they were a Medicaid practice, right? And that's changed dramatically to a focus on revenue generation, right? On sort of right people, right time in terms of scheduling. While no question in the 90s, practice management was, let's see how many patients we can get every particular professional to see in a particular day. That's changed to how efficiently can we get the right amount of people to see the right types of patients in any given day, right? And then we're using real significant technology to do that. And the money behind that technology didn't come from, you know, just some practice deciding to spend it. It came from really from private equity deciding to invest in those kinds of things, and use that kind of technology to push us forward. And, you know, again, I'm biased, obviously, but I think that those are the kinds of stories that have to counter the stories of, you know, bad care in nursing homes. And by the way, that private equity in nursing homes is generally on the landlord realty side. It's not on the operations side. And they're kind of, unfortunately, Washington is kind of mixing and matching something that's apples and oranges. But with that said, we have another 60 seconds or so, and so I'll open it up to the panel for any parting comments before we say goodbye.
None for me. Well stated there.
Yeah, same. Enjoyed the discussion. A lot of great topics. I think, you know, healthcare in some ways is not different than a lot of other sectors. I think you know, a lot of the themes we discussed around level of competition, speed, approach to diligence, we certainly see in our other two industry verticals. But this last topic around the regulatory piece, I think, makes healthcare a little bit unique, because there's certain areas where it's hard to take shortcuts. I think people get burned there, and so I think that's some of the complication, but also the opportunity in healthcare.
Yeah, no, I appreciate you having us. It's a great discussion, and I think, you know, healthcare's always has been and continues to be a really exciting place to spend time in. A lot of evolution on the technology or payment or really just the healthcare system more generally. And there's a lot of opportunities to continue to help deliver better care to the patients here. So I'm pretty excited about what's to come over the coming years.
Well, Nick, Mike, Pete, thank you so much for joining us today and for this really wonderful conversation about these issues. I appreciate you taking the time, and certainly Venable appreciates you taking the time. I hope that our folks who participated in the program really enjoyed the conversation. I know I did. And thanks so much, and take care. We'll see you soon.
Thank you.
Thanks all.